Bank of England has hiked rates for the fifth time in a row to try and rein in inflation. The Monetary Policy Committee voted 6-3 to increase the benchmark lending rate by 25 basis points to 1.25%. The bank faces a very difficult task of bringing consumer prices back under control against a backdrop of slowing growth and a rapidly depreciating currency, as well as a major cost of living crisis as well in the UK. Now, the decision comes on the heels of an historic rate hike by the US Federal Reserve, which increased its benchmark rate by 75 basis points on Wednesday.
And I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting and will continue to communicate our thinking as clearly as we can.
For more on this now, let's bring in Massimo Massimilla, who is partner and CIO of Albemarle Asset Management in London. Massimo, many thanks for being with us today. So, fifth rate hike in a row in the UK. I mean, is this really going to help with the situation on the ground? Because, Massimo, at the same time, we have a depreciating pound, we have a real cost of living crisis in the UK. Is this measure going to be effective?
Yes, I think it will be effective ultimately. Bank of England has been the first central bank to start hiking interest rates. And as you pointed out, has hiked 5 times by 25 basis points, getting to 1.25%. And it will probably continue hiking. What Bank of England is doing differently from the Fed and also from the Swiss central banks, for example, is the hikes are being in small increments, slow, because the economy in the UK is already in recession. Bank of England said today that in the second quarter, the economy is, likely to have a minus 0.3% GDP growth. So the economy is already in recession. Demand is already slowing down. Therefore, Bank of England has decided to move slowly on the interest rate front.
All right, so a question on capital markets as well as on the real economy. I guess investors are wondering, where can we find a safe havens? How can we hedge against this high inflation risk and recession as well as stagflation risk?
Yeah, there's no magic asset, unfortunately, or magic rule, unfortunately, in the world of investments. Believe it or not, I personally think that there's some degree of overshooting going on in terms of bond sell-off. In the US, we now have 10-year treasuries yielding 3.4, 3.5%. And I think people are underestimating the impact of the current rate hikes, the slowdown in demand that is already underway, and the effects of a slowing U.S. housing market, a drop in equity benchmark this year. All these effects, I think they will produce a decent slowdown in the next few months. And we could be here 3 months from now and have a declining inflation and core inflation, a declining demand. And therefore, these yields that are currently offered by U.S. Treasuries, could be actually really attractive.
Right, just because you hinted at that, I mean, Powell said the next increases will be not of the same magnitude, but he did say that some pain will be necessary. Now, what pain are we talking about? I mean, are we talking about a short recession? Are we talking about something longer, a stagflation?
The good news here is that long-term inflation expectations have already peaked, and you can see this when you look at the U.S. Inflation break-evens, which on a 10-year basis are, basically in line with where they were, a few days ago, and same thing on a 5-year basis. So inflation expectations for the long term have already peaked, and this suggests that a lot of rate hikes are already priced in. A lot of action is priced in. And if anything, I personally believe that the Fed will actually have flexibility to pause at a certain point and therefore avoid like a hard recession, which many people are now expecting.
Massimo Massimilla, many thanks for being with us today.